President Donald Trump's pledge to secure 100 trade deals within his first 100 days has failed to materialize. Instead, the administration's vague tariff letters have stirred investor uncertainty, triggered sharp market losses, and contributed to a decline in the value of the U.S. dollar. Is the United States unintentionally undermining its leadership in global trade? Trump's ambitious plan to secure 100 trade agreements in his first 100 days has not produced results. As of late June 2025, no major agreements have been signed, and many negotiations remain stalled or unclear. Rather than delivering formal agreements, the administration turned to unilateral tariff letters. Announced targets included Japan, 25%, and Portugal, 50%. But promised dates, May 16th and June 11th, passed without official documentation. The absence of action raised doubts about the strategy's readiness and credibility. This lack of clarity has affected investor confidence and strained relations with trade partners. A strongly declared but unfulfilled trade agenda undermines U.S. credibility both domestically and globally. For American exporters, policy unpredictability has complicated business planning and delayed investment decisions. Trump's tariff letter approach, presented as an alternative to formal trade deals, has been widely questioned. Legally, such letters hold no enforcement power and cannot substitute for executive orders. Observers view them as political messaging rather than functional policy. With no binding authority and no enforcement steps, trading partners have responded skeptically. Some halted negotiations, others retaliated. Canada revived its digital tax plan, while the EU deepened trade alignment with Asia. The U.S. risks marginalization in key global sectors, such as electric vehicles, semiconductors, and aviation. At the ground level, policy uncertainty is disrupting operations. Businesses report difficulties in supply chain planning and market expansion. For consumers, unresolved trade tensions may raise prices and reduce job stability, especially in export-reliant industries. Although tariffs were not implemented, announcements alone triggered a major market reaction. Following Trump's April 2, 2025 press briefing, the U.S. stock market lost over $6.6 trillion in value within 48 hours, one of the sharpest drops since the pandemic. Major indexes tumbled. S&P 500 fell 10%, NASDAQ 11%, and Dow Jones over 1,600 points. These declines signaled investor concern over rising trade conflict, supply chain risks, and weakening global demand. Export-heavy sectors like technology, manufacturing, and autos were hit hardest. The U.S. dollar also declined by 10.8% in the first half of 2025, its steepest fall in over 5 decades, according to Bloomberg and the Federal Reserve. The weaker dollar raises the cost of imports, from consumer goods to industrial components, reducing real purchasing power. Government borrowing costs have risen too, as bond markets demand higher yields. This affects mortgage rates, car loans, and credit access, adding pressure to households and federal budgets. In a slow growth, high inflation environment, such volatility only adds to economic headwinds. Canada's expanding exports are quietly reshaping North American trade, as long-standing American advantages begin to slip away. What does this shift mean for the everyday lives of American families, especially those who've spent decades building their livelihoods in trade and manufacturing? Canada has officially launched its first major shipment of liquefied natural gas, LNG, from the newly operational LNG Canada facility in Kitimat, British Columbia. With an initial capacity of 5.6 million tons per year, this project provides a direct shipping route to Pacific markets, significantly cutting travel time compared to U.S. Gulf Coast ports. Major international companies such as Shell, Mitsubishi, and Petronas have signed long-term agreements, citing Canada's logistics, advantages, and competitive pricing, offering LNG at $0.71 per M MBTU, cheaper than U.S. benchmark Henry Hub prices, according to Bloomberg's June 2024 report. This new reality spells trouble for thousands of workers in the U.S. natural gas sector, especially in states like Texas and Louisiana, where export orders are shrinking. With contracts shifting north, many American workers face a tangible risk of layoffs or reduced shifts, as Canada becomes the supplier of choice. Beyond jobs, U.S. households may see higher domestic energy prices as more American gas stays home, driving up costs and putting pressure on monthly living expenses for families and retirees. Industry analysts from S&P Global expect Canada's LNG output to more than double by 2027, further expanding its footprint in Asian markets. If current trends continue, the U.S. could lose up to 30% of its LNG export share to Canada within 5 years, leading to deeper job cuts and potentially fueling regional economic slowdowns in key energy states. Some experts even predict that U.S. gas infrastructure could face underinvestment, affecting long-term reliability and pushing local governments to seek new economic alternatives for affected regions. Canada's reputation for clean, transparent, and sustainable exports is drawing new demand in global markets, particularly for FSC-certified lumber, organic wheat, cheese, and hydropower equipment. Vancouver has overtaken many U.S. ports as the primary gateway to Tokyo and Seoul, with American ports reporting reduced activity. According to the U.S. Department of Agriculture, Canadian wheat exports to Asia rose 18% in 2023, while U.S. shipments dropped 11% in the same period. This market migration has concrete effects on American workers, notably those in agricultural processing in Pennsylvania and Michigan, who are losing export contracts and being forced onto less profitable day shifts or even let go. Supply chain disruptions ripple across entire communities. Layoffs mean loss of employer-sponsored health insurance, reduced savings, and growing economic stress for families who once relied on export-driven industries. Trade experts at the Peterson Institute predict Canadian agricultural exports to Asia will continue rising, possibly surpassing U.S. levels in key categories within 2 years. Unless American producers can match Canada's standards or cut costs, job losses and plant closures could accelerate, especially in the Midwest and Northeast. Policymakers warn that unless bold steps are taken to modernize American agriculture and invest in export infrastructure, the country risks losing ground in sectors that once formed the backbone of rural prosperity. Global confidence in Made in USA is starting to slip as multinational buyers turn to Canadian suppliers for greater policy stability and reliable delivery. Recent high-profile contracts in LNG, uranium, nickel, and lithium have shifted to Canadian firms, a move largely credited to Canada's consistent regulatory environment and absence of sudden tariffs, as reported by the Wall Street Journal in May 2024. For many, the Canadian advantage is simple. Contracts are honored and shipments arrive on time. Communities in Ohio and Missouri, once thriving on export manufacturing, now face plant slowdowns and lost deals. Small towns built around logistics and transport are seeing warehouses empty and truck fleets idled. Many business owners report that domestic-only delivery brings lower margins and fewer opportunities, making it harder to sustain jobs or reinvest in local growth. Economists at Moody's Analytics warn that without policy reforms or renewed trade competitiveness, American export hubs could see a persistent decline. Over the next 5 years, entire regions may shift from industrial growth to stagnation, impacting both blue-collar and middle-class families. The longer-term challenge will be revitalizing innovation and rebuilding trust with global partners, which could determine America's manufacturing future for decades. For many Americans, and especially in the Midwest, these economic shifts mean more than just lost jobs. They signal a profound loss of faith in the future. With income and employment vanishing, older families are being forced to tighten budgets, cancel plans for college tuition, or forego essential health insurance. The psychological toll is real, with many expressing anxiety about their children's prospects and the survival of their communities. When a local plant closes, schools face funding shortfalls and may be forced to shut their doors, while homes sit vacant and youth migrate to more prosperous cities. These two-speed communities foster a growing sense of fear and insecurity. Surveys from the Pew Research Center, 2024, reveal a sharp drop in national pride linked to manufacturing and export declines, raising concerns about the social fabric and the resilience of the American dream. Sociologists from Harvard University suggest that unless new job opportunities emerge or robust social safety nets are enacted, American towns at the center of these changes may face a lasting divide. Rebuilding economic confidence and restoring faith in Made in USA will require collective action from policymakers, business leaders, and communities alike. Without concerted efforts, the risk is that generational hardship and disillusionment become the new norm in many parts of the country. Forecasts show ongoing challenges as Canada rises in export power, and American communities feel the impact. Only by uniting and taking decisive action can Americans protect their livelihoods and revive the spirit of national industry in the face of these global shifts. The U.S. is facing a dramatic decline in international tourism, with ripple effects felt by millions of Americans. How might shrinking visitor numbers quietly reshape the future of your town? In 2025, international visitor spending in the U.S. is projected to drop by 7%, which translates to a loss of $12.5 billion compared to the previous year and stands at only 78% 2019 peak, according to the U.S. Travel Association. In March 2025 alone, arrivals of foreign tourists fell 14%, raising the possibility of a $21 billion loss if this trend continues throughout the year. This is not just a dip in numbers. These are visitors who fill hotel rooms, eat in restaurants, and shop in American stores. For millions of Americans, the impacts are already close to home. Hundreds of thousands of jobs in hotel, restaurants, travel services, and support sectors now hang in the balance. In smaller tourist towns, where local budgets depend on outside visitors, falling income has already triggered reductions in healthcare, education, and social services. Families in these communities are finding it harder to access essential public services, all because fewer international travelers are spending money in their areas. Looking ahead, experts caution that unless there's a dramatic turnaround, U.S. destinations could face long-term challenges in regaining their pre-pandemic position in global tourism. Persistent declines could mean further job losses, reduced tax revenue, and a slow erosion of vital community services nationwide. Without bold steps to revive tourism, millions of Americans may continue to feel the economic pinch for years to come. There is a growing call for policymakers to consider new strategies, like streamlined visa processes and marketing efforts, to boost America's appeal to international travelers. Travelers from Canada and Mexico are changing their plans, with visitor numbers down about 20% in early 2025, according to the International Air Transport Association. Bookings on Canada. U.S. routes have plunged by 70 to 76%. Western European travelers, especially from the UK, Germany, and France, have dropped by 17 to 30%. Meanwhile, Australian arrivals have also sharply declined. Several governments, including Canada, the UK, and China, have issued public safety advisories, urging their citizens to reconsider trips to the U.S. due to concerns over security and stricter entry policies. For Americans, these choices have direct and visible effects. In cities like New York, the loss of up to 3 million foreign tourists could mean a $4 billion hit to the local tourism industry this year. Along the border, duty-free shops and cross-border transport services report revenue drops of over 40 to 80%, leading to significant job cuts in those areas. These are not abstract numbers. These are lost jobs, shuttered businesses, and reduced family incomes across the country. Experts warn that if current travel advisories and policies remain unchanged, the U.S. could lose even more ground in the competition for global tourists. American communities that depend on Canadian, European, and Asian visitors may struggle for years to rebuild, risking long-term unemployment and slower economic recovery. Calls are growing for American cities and tourism boards to coordinate international outreach and improve the visitor experience, hoping to reverse the downward trend. Soaring inflation has driven up the price of airfares, hotels, and dining out, making vacation dreams unaffordable for many Americans. Recent surveys by the U.S. Travel Association reveal that nearly half of American travelers are cutting back on their vacation spending. For many, the sentiment is summed up by one expert's wry observation. Americans no longer plan vacations. Now they just hope they can afford a burrito. This trend hits local economies especially hard during what should be the busy summer season. Hotels, amusement parks, car repair shops, and souvenir stands are all feeling the sting. Workers in the domestic tourism industry face reduced hours or even layoffs as American families pull back on their travel plans. Many seasonal workers who rely on summer tourism for their income now find themselves with fewer shifts and lower earnings. If prices remain high, industry analysts predict continued sluggish demand for domestic travel throughout 2025. That means even more pressure on local businesses, a weaker job market in travel-dependent communities, and lasting changes in how Americans choose to spend their free time and money. Families may have to seek more affordable leisure options close to home, altering long-standing traditions of summer vacations and family road trips. This downturn is not driven by another wave of COVID-19. Instead, it is a crisis of confidence. U.S. visa policies, ongoing trade disputes, and a global image of America as less welcoming have led many would-be visitors to look elsewhere. Major financial institutions, such as J.P. Morgan and Goldman Sachs, have warned that the U.S. tourism sector is unraveling. As travelers opt for destinations they perceive as safer and friendlier. For ordinary Americans, this trust crisis hits hardest in states like Florida, Nevada, New York, and Illinois. Communities in these regions are experiencing falling revenues, job insecurity, and concerns over future retirement funds as tourism dollars disappear. Beyond the immediate job losses, there is a growing sense of unease about the nation's reputation abroad. The decline in visitor trust not only damages the Made in USA brand, but also shakes America's standing as a global economic leader, raising new questions about national safety and responsibility. Experts suggest that unless America restores its reputation for openness and reliability, international tourism could remain depressed well into the future, with consequences for jobs, community stability, and the country's economic influence on the world stage. Observers stress that efforts to rebuild trust and create a more welcoming environment must begin now if the U.S. hopes to regain its place at the center of global travel. Experts see continued turbulence for both international and domestic tourism, with no quick fix on the horizon. Now is the time for Americans to rethink, adapt, and support both local businesses and policies that can help rebuild trust and opportunity for everyone. Major wheat markets are turning away from U.S. supplies, disrupting long-standing trade ties and shaking the stability of American agriculture. How far will these changes ripple through the communities and families that have relied on wheat for generations? In May 2025, USDA reports showed net cancellations of U.S. wheat exports hit 128,800 metric tons, including 65,000 metric tons from the Philippines, 61,500 from South Korea, and 103,400 from undisclosed buyers. The Philippines, once a key importer, sharply cut back, while Mexico and other markets have also pulled away amid trade uncertainty and logistical issues. These cancellations have slashed expected revenues and damaged long-standing trade ties. The impact is hitting hard across wheat-producing states like Kansas, Texas, and Oklahoma, where unsold grain fills warehouses. With exports stalled and weak domestic demand, some farmers have burned crops or sold at steep losses to stay afloat. Local mills, reliant on exports, have scaled back or shut down, triggering layoffs and rippling through rural communities. For families rooted in wheat farming, pride is being replaced by growing anxiety over the future. International buyers are prioritizing quality and transparency over tradition. South Korea's cancellation of 61,500 metric tons of U.S. wheat contracts highlights concerns over chemical residues like glyphosate and poor traceability. France, aiming for lower carbon footprints and clearer supply chains, is shifting to more reliable suppliers, especially Canada. This reflects a global shift towards stricter food safety and environmental standards, where U.S. wheat is losing ground. For growers in Washington, Idaho, Montana, and Kansas, these changes bring real economic pain. The loss of hundreds of millions of dollars in contracts is forcing difficult choices. Flour mills have cut capacity, hours, and wages, while some farm families face selling land or leaving agriculture. Youth are leaving as hopes for a stable farming future fade. This decline in demand is not just economic, it's a cultural blow to communities rooted in the harvest. Canada is filling the gap left by declining U.S. exports. For 2024 to 2025, wheat production is projected at 35.0 million metric tons, with exports expected to hit 26.05 million, underscoring its growing global role. Backed by stable policies, modern transport, and a reputation for transparency and reliability, Canada is securing contracts once bound for U.S. ports. This approach attracts quality-focused buyers and ensures steady income for Canadian farmers. For Americans, this development is about much more than losing market share. The U.S., once seen as the world's most dependable source of wheat, now faces a crisis of reputation. As Canada takes over the mantle of global wheat leader, American farmers are forced to confront shrinking opportunities, the loss of international trust, and a potential long-term decline in rural prosperity. Jobs in farming and transportation and food processing are at risk. Entire communities grapple with the uncertainty of what comes next. For those whose lives have been shaped by the wheat trade, the challenge is not just to adapt, but to find new reasons for hope and resilience in a rapidly changing world. Tensions in the Middle East are shaking the world's energy markets and hitting American wallets harder than ever. Could rising oil prices and geopolitical risks disrupt your daily life and future financial plans? Iran's parliament has formally approved a motion to close the Strait of Hormuz, a waterway responsible for transporting 20% of the world's oil, about 21 million barrels per day, according to the U.S. Energy Information Administration. The move follows a series of airstrikes targeting Iranian nuclear facilities, reportedly involving both U.S. and Israeli forces. While awaiting final approval from the Supreme Council, Iran has already ramped up its naval presence, deploying patrol vessels, anti-ship missiles, and staging military exercises near the strait. This sharp escalation signals a critical point of tension in one of the world's most strategically vital regions. For American families, the ripple effects have been immediate and severe. Gasoline prices shot up within hours, with California, Texas, and New York seeing the highest spikes. According to AAA, the national average for gasoline rose by more than 15 cents in a single day, the steepest climb since early 2022. Everyday costs are climbing as fuel prices impact shipping, packaging, food, and electricity. Middle-class households now face higher grocery bills, pricier commutes, and increased home energy costs, stretching budgets across the country. Looking ahead, energy experts warn of prolonged instability should the strait remain at risk. The International Energy Agency predicts global oil supply disruptions could continue for months. Analysts from Reuters say U.S. gas prices may set new records this summer, with ripple effects spreading to inflation and interest rates nationwide. The world's dependence on Middle East oil and America's exposure to these supply shocks are now impossible to ignore. Brent crude prices jumped 3.9% to $80 per barrel, while U.S. benchmark WTI soared 4.3% to $77, the sharpest single-day gains in over a year, according to Bloomberg reports. And it's not just oil. Qatar's liquefied natural gas exports, much of which also transit the Strait of Hormuz, face severe disruption risks. Natural gas prices in Europe and Asia responded immediately, with U.S. futures also climbing as global supply chains brace for tighter markets. For Americans, the squeeze isn't limited to the gas pump. Rising energy costs are hitting supermarket shelves, electronics stores, delivery services, and utility bills. The U.S. Bureau of Labor Statistics notes that transportation and shipping make up nearly 10% of consumer prices, meaning any hike in oil or gas triggers wider inflation. Sectors such as airlines, trucking, and manufacturing have little choice but to raise prices or cut jobs, placing direct pressure on family budgets, especially for working Americans and small business owners. Forecasters at Goldman Sachs now warn that further price spikes could accelerate inflation above 4% this year, forcing the Federal Reserve to delay any rate cuts. Supply chain specialists predict potential shortages of everyday products, higher transportation costs, and possible job losses if the disruptions persist through the summer. U.S. financial markets are in turmoil. Energy stocks like ExxonMobil surged, while shares in airlines, retailers, and logistics companies plunged, as tracked by the S&P 500. Meanwhile, the Federal Reserve is signaling it may postpone any planned interest rate cuts, citing new inflation concerns tied directly to rising energy costs. For everyday Americans, these shifts are hitting close to home. Persistently high inflation has made it harder to qualify for credit cards, mortgages, or auto loans, with interest rates holding steady at multi-year highs. Workers who drive for a living, delivery drivers, truckers, small retailers face shrinking profit margins and greater uncertainty about the months ahead. Many middle-aged Americans worry about affording retirement savings, family travel, or even day-to-day expenses, as costs escalate, with no immediate relief in sight. Financial analysts predict continued volatility in stocks, especially for sectors exposed to energy costs. If oil remains high, the likelihood increases that both inflation and unemployment could edge upward, putting a strain on the broader economy and the personal finances of millions of Americans. The U.S. Fifth Fleet, stationed in Bahrain, has doubled its presence in the Gulf alongside British, French, and Gulf Arab warships. According to CNN, Iran, in turn, has deployed fast attack boats, drones, and anti-ship missile systems around the strait, creating an atmosphere described by security experts as a powder keg. Even a minor incident could trigger a broader military conflict. U.S. and allied officials have outlined contingency plans to secure shipping lanes should Iran fully blockade Hormuz, a scenario with global ramifications. If conflict erupts, the impact on American households would be swift and harsh. Oil prices could surpass $100 per barrel within days, raising the average U.S. gas price to over $5 per gallon, based on analysis from the U.S. Energy Department. The specter of another Middle East war would drive up defense spending and taxes, lead to higher prices across the board, and potentially push the U.S. economy toward recession. For American veterans, military families, and everyday citizens, the risks and costs are impossible to overlook. Defense analysts predict that even if open conflict is avoided, the elevated military presence and ongoing standoff will keep energy markets volatile. The threat of accidental clashes or miscalculations will linger, ensuring a climate of uncertainty that weighs heavily on global markets and U.S. consumers alike. Analysts caution that rising energy prices and military tensions may shape the American economy and daily life for months to come. Now is the time for Americans to stay informed, review their finances, and prepare for further volatility ahead.